how do I best prepare for taxes and still pay myself. So we're going to be talking about money this week, and money and taxes is something that make people feel really uncomfortable. And so there was really no great way to prepare for taxes other than to prepare for taxes, right? So the idea is that you would want to create a separate account, whether it's a savings account or some kind of account where you put money away every single month for your taxes. When you own a business, you have to pay taxes every quarter so that you don't face a penalty. So you want to make sure that you get used to paying taxes every quarter. You may still owe some taxes at the end of the year on April 15th when we all owe our personal taxes. So that's going to be really important if you've made more money during the year, if something changed during the year, like maybe you got married or you got divorced or some kind of status change, maybe you had children. And so some of those things do help, like having children, I think helps you with your taxes, but you just want to be able to best prepare for your taxes. So there's a really good general rule of thumb, which is to put aside 15% of your gross income into an account so you can prepare for taxes. So if you were to make $1,000 in a month, you would put $150 away. And so that doesn't seem like a lot of money. Some people were asking questions, but 15% in my state, it's much more. It's like 30%. Well, again, the general rule of thumb is that you would pay yourself 50%. So you would, if you made $1,000 a month, again, if you watch me, I like to use nice, simple, plain numbers. You make $1,000 a month. You pay yourself $500. 30% of $500 is $150. So you're only setting aside 15% of your gross. That's before you pay yourself, before your expenses, before anything else. But it's really going to be closer to that 30% for the amount that you're actually paying yourself. Now, if you happen to live in California or somewhere else where there is a high state income tax or state-to-state income tax in general, you may want to pay yourself 20%. So then it's really 40% of what you're paying yourself. So it starts to equate out. So I hope that makes sense for people. You can adjust these numbers. So if you happen to live in an area where there are higher taxes, you may, one of two things, you may pay yourself less or you may have lower expenses. Usually when you have an area that has higher taxes, there's a higher cost of living. So your expenses really aren't going to be that much different. So you would probably have to take a cut in how much you pay yourself, but you may also live in an area where you can command, let's say, $200 a session or even $150 a session. And so if you were to make, let's say you were to bring in $10,000 a month, you would put aside $2,000 for taxes. If you were paying yourself 20%, you would pay yourself $4,500. You would have $3,000 for your expenses, which I hope would be able to cover rent for you and the other things that you have to pay for. And you would have about $500 to put away in a nice profit account. And so that's how that would work. But really, in order to prepare for those taxes, what I would do and what I recommend that you do is you take that $2,000 every month and put it into a separate account. So when that bill comes every quarter, that you have that money set aside for yourself. So I just want to take a moment to thank our sponsor, TherapyNotes. If you are looking for an electronic health record, that is a tax deductible expense. Man, I shouldn't say that 3 times. I want you to take a look at TherapyNotes. They have wonderful customer service and they're really great at answering your questions and helping guide you through the process so that you can make whatever amount of money you want to make every month. So then that way you can pay your taxes and pay yourself. So be sure to check out TherapyNotes. So jumping back to the idea that you would pay you would set aside the taxes, you could pay yourself and you could adjust those. In the beginning, a lot of the times expenses are high when you're just starting out a private practice. So don't feel like, oh my goodness, like I have to buy this, and this. I have no money to pay myself. If you have another job or some other sorts of income, that might be okay. For some people, if you're just starting out, you may have to really cut your expenses, really be mindful of that. And again, as always, you want to work with an accountant to understand how much money you're really going to owe every quarter. They can help prepare that. They can do projections. You can really do projections every month. So depending on your relationship with your accountant, but just know the IRS wants their money. They're not passive. They're going to send you, little notes to remind you that you do owe taxes. So just be comfortable and be prepared with taxes. I know it's not a fun word, taxes, but when you own a business, it's a necessary word. Okay, everybody, I'll see you every day, 3 o'clock. I'm here. Bye.